you obtain will inform you the type of opinion that you need to form, the type of opinion that you need to form. And this gathering of evidence, we said that the evidence should be sufficient, the evidence should be appropriate. And we said that ISA 500 tells us that if an audit evidence is sufficient, what it means is that it is we have the right quantity that we want. And we say an evidence is appropriate. We are looking about the quality of this evidence that you have obtained in the course of our auditing processes. So we also said that this, when we say if it is appropriate, what it means, it is relevant and it is what reliable. And we also did mention that if we are gathering the evidence, we also have analytical procedure. And this analytical procedure is mostly used to evaluate the relationship or the plausible relationship between financial as well as we computing the ratios, as we comparing the amounts that we have against the benchmark. All these are what analytical procedure. And we say in analytical procedure, when we are doing the comparison, you compare it with the budgeted ones, or you compare it with the last year figures, or you compare it with the industry standards. So those are and we also made mention that the analytical procedure occurs at all the three stages of audit, all the three stages of audit. In the three stages of audit, we have the planning stage, the substantive procedure stage, and the final review stage. And with all these, we perform analytical procedure. So note that with the analytical procedure, we need it at the planning stage to assess whether or not the financial statements are consistent with the auditor's understanding of the entity. So we need to do the analytical procedure so that the auditor will understand if the financial statement is consistent with what the auditor understands about this entity. So it performs. Then we also made mention that there are some assertions in the financial statement that the auditor must also verify, must agree to them. And these assertions are the figures or the amount in the financial statement. So when they mention sales, what is the amount? Cost of sales, what is the amount? Inventory, what is the amount? All these are assertions that we have it in the financial statement that the auditor must ensure that they are accurate, they are complete, they are well classified and presented, they are well evaluated, and then the occurrence of one may bring about another thing occurring. So maybe the occurrence of sales may bring about receivables, because when you sell your product, it will lead to people, some of them not be able to pay on time, others also taking credit facility. What it means is that the occurrence of one also lead to another occurring. So the auditor must ensure that all these are being verified and then they are well recorded. Now, based on what we have said, we said last week, maybe in your readings, you find out of something you want to share with us. Can you tell us, or maybe you have a question from your readings? If you want to ask, you can ask before we continue with today's class. Any question from our previous class that we had? All right, so if there is no question, let us just look at audit sampling. Now, if the auditor wants to audit a particular company, It doesn't audit the whole organization, but he deals with some. So the sample that he needs to determine, it has to be on the engagement. It has to be in engagement, telling them that this is the sample that we intend to do, or this is the sample that I want to check. So with the sampling, what you must note is that it involves redetermining the sampling design, or the auditor determining the sampling design, and I will explain them. The auditor coming out with the sample size, the auditor coming out with the sample selection, the auditor determining the performance of the audit procedures, performance of the audit procedures. And the last one, evaluate sample results. So audit sampling that they go through. And this process, that is where they're able to determine the type of things that they are going to examine, the type of transactions, the type of balances that they are interested in, the type of issues they want to deal with. They want to deal with the whole organization. If they want to deal with the payroll aspect, that is where they are. If they want to go in with some of the transactions that are downside. So in terms of the payables, in terms of the people that we are owing, they will want to investigate it. It is all based on this audit sample. Now, when we talk about this sampling design that you are seeing over there, this sampling design normally refers to the population that we have specified that we want to deal with. So the population that they want to, so the population mostly refers to all the issues in the organization. So in organization, you may have the payroll session, you may have the HR session, you may have the sales session, you may have the accounting and the marketing session, you may have the those who normally prepare the payroll might be also, maybe the payroll is separate from the main final account session. So all of them form part of the population. So if he's trying to specify the population, he's trying to determine the type of sample that you want to deal with. So in the population, you get to know the various samples that you have. Then you will now come up with a sample size so that you reduce what we call the sampling risk. Because what I think is that if the auditor is selecting or is determining some number of transactions you want to deal with, you have to ensure that there is no sampling risk. That is a risk that you take in the sampling. You have to ensure that the actual quantity that you need to sample, when you intend to deal with, are the people that you already. Then as well, you need to come up with a sample selection as the method you apply in determining the sampling size. Because if or the sample that you are selecting. So if it says I'm going to select 45, what is the method that you going to use in the selection of the 45? Because you have defined the population and it says I need 45. That is so what method is it going to use selection of this 45 transactions that you want to do with? That is a sample selection. Now, if he's able to know the sample selection method or the selection method, they will go in for, which are going to discuss them later. So now do what we call performing audit procedures. That is what test the selected items. So select items, you decide to test them to see which of them um, will have.
Sir, please.
Yes, please.
Okay.
Yes.
Your voice is like it's very small. I don't know if it's from
Right.
my end.
Right. Right. Yes. Please, I hope you can hear me now.
Yes, dog. Thank you.
Right. Right. So with the performing audit procedure, is just looking at how we are going to test the selected items. So the selected items you are going to deal with, how are we going to test them? And this will depend on the test controls that you have that the company want to use, or the test of details that they have that they want to use in performing this particular audit. Then what they also will do is that they will try and investigate whether there are errors in their selection and whether they can use the sample that they have selected to conclude about the population, to have a conclusion about the population that, okay, based on the sample that you have selected, we think this is what is happening in this population. So that is what we call evaluating or evaluate the sample results. So that's why they try to test all errors and try and conclude on the population that they sampled from. Now, in sampling, they normally add what we call, or they normally apply statistical sampling. So they apply what we call statistical sampling in this sampling method that we are or this other sampling that they are talking about. Now, with this sample selection, sometimes they can go with what we call random selection. So random selection, or they will do random, the method that they will apply in selecting is what they would apply what we call the random selection. And with this random selection, what happens is that it's normally the best way they want, if they want to remove any biases, if they want to avoid, they want to ensure that every item have a representative in the sample. So maybe if they want to sample 40, and with the 40 that they intend to sample from the population, they have to ensure that the 40 that they are sampling from, they all have a representation population, in the population, so that one or the other, it doesn't create what we call biases. It doesn't create what we call biases. So most often, auditors normally adopt what we call the random selection, such a way that if they are selecting, it will not be biased. They will remove all sorts of biases from what their selection. Another method also they can use is what we call interval selection. Interval selection. So this is a little bit close to the, or is just an approximation of the random selection. It's just very close to it. But what happens is that maybe there are 20,000 invoices they have in the population. So if they decide that, okay, looking at the 20 invoices, that could what we intend to look at. So what it means is that with this 20,000 um with these 20,000 invoices, they will tell themselves that, okay, this is the first 20. When we count 100, we will pick the next 20. Then they will they will count another 40, then they will pick the next 20. So this is interval. That is what they intend to do. So they'll look for every counting that they do, maybe so every 10 interval, they'll pick one invoice to deal with. So maybe as I said over here, so you can have something like this. You can have 20,000 invoices for what you have over here. And they will say that, okay, these 20,000 invoices, after an hundredth one, or after the 100th one, they'll pick 20. So they'll first pick 20. So this is how they'll first pick 20, and they will count 1, 2, 3 up to 100. After that 100, they'll pick the next 20. Then they will still count 1, 2, 3, 4, 5, 6, 7, 8, 9. After another 100, they pick another 20. This is what we call the interval selection. The interval selection. But with a random, when they pick the 20,000 invoices, randomly they can pick any of them. They can pick number 1, they can go in for number 2, they can go in for number 3, they can go in for number 4. This is the random selection. So that it will not be like there is bias, that is something that's influencing them. Another way of they selecting the sample is what they use, what we call haphazard. So haphazard selection. And most often, this is frequently used because it is one or the other convenient for the auditors. So maybe when an auditor open a file and will say, okay, randomly, I'll pick an invoice which is open. So they work in there. Okay, this invoice have been opened. Let me pick it. Then you go in. This invoice is there. Let me pick it. So again, it goes here. This one is open. Let me pick this. So let me look at it. And then so you just picking it just haphazardly. That is what we call haphazard selection. Haphazard selection. So that is what happened there. Then we also have the block selection. The block selection. So the block selection is like maybe selecting 20 for these invoices. You are selecting 20 in a sequential order. You have told yourself that this is the order that you want to select. So selecting the 20 invoices from here in a sequential order. So depending on how they have been filed. So when you go to the office, they are file 1, file 2, file 3, file 4. So during the selection stage, they wanted to go it by block. So they go up from 1 to 10. That is what we want to select. That is what happened. So sometimes they can have invoices maybe from the same supplier, but then because it is in a block form, they can just go and say, we want these invoices from this side. Then they will just deal with it. That is what we call the block selection. We also have what we call stratification. So we have what we call stratification selection. Stratification selection. And this stratification selection is just a way of dividing the population into subpopulation. So in here, they try to divide the population into subpopulation. So in the population, there's another subpopulation in that same population. So they do that because they think that these particular people have some characteristics. They have figures that are a little bit closer. So let us put them into this particular population to deal with. So the big population and also have another population in that same population. They do that is what we call stratification. That is what they normally do there. So when they are trying to evaluate it, they evaluate the subpopulation separately from other population. That's what they normally do. So when they are going to do the audit, this one is a scientific, they try to select a particular way that they will use in their auditing sampling or audit sampling. That is what that they normally do. Now, note that if they are evaluating the results or evaluating sample results, what they are trying to do is that they want to test the controls that they have. They want to test the controls that we have, whether the controls that they have in organization, it is okay or it is not okay. Now, that brings us to another subheading called internal controls. Internal controls. Internal controls. Now, note that before an auditor comes into is to audit a particular company, he needs to know the internal controls of that particular company. He needs to be aware of the internal controls. So the internal controls, how transactions are being recorded, who approves what, who is in charge of the various activities, who does the approval, who keeps the transactions, who does the recording. All these things, they are part of the controls that in organization put in place to ensure that the organization is well managed, the organization is well organized in such a way that it will not affect, it will not one or the other reduces the worth of the shareholders. That is what happened. Now, note that in a way to understand the internal controls, the auditor must be aware of the client accounting system. So note, client accounting system. The auditor must have an idea about it. Because if he has an idea about the client account system, it will enable the auditor to be able to evaluate the type of internal controls that they have put in place for the organization. So that is what happened, that if he is able to know the client's accounting system, then the auditor will be able to evaluate that, okay, these are the internal controls that that is what my client have in his organization. That is what happened. Now, in for these internal controls, as I already said, they are there to ensure that the organization perform its activities well or are being well governed in the organization. Now, we have components of this internal control. Now, the components of internal control, we have the control environment. I will explain all of them. We also have the risk assessment process. We also have the information system. We also have control activities. And we also have monitoring processes. So these are the components of internal control. Now, when we mention the control environment, the control environment tries to provide the foundation for other components of this internal control. So what does it do? It is able to tell how management have oversight responsibility to be carried out. So here, it goes into the organizational culture. It goes into management committed to ensure that there is integrity and ethical values in the organization. It's trying to tell us that those charged with governance are separated from management. With a control environment, it's able to assign authorities and responsibility. And with this control environment too, it is able to tell that how competent individuals are, how they have been well developed, how they were attracted, and how we have retained them. This is about the control environment. Then as well too, with the control environment, it is able to tell how each and individual in organization are held accountable for their actions relating to the system of internal control. So with the control environment, it serves as a foundation for all other components of what? Of this internal control. I said it's able to tell management there are oversight responsibilities that they need to carry out. It is able to tell the responsibility of those charged with governance. That is, those who are actually separated with management. It is able to tell us the authorities and the responsibility of each and everyone in the organization. With a control environment, it is able to attract individuals, tell how individuals were being attracted, how they are being developed, and how they have been retained. And I also said that it's able to tell how individuals are held accountable for their responsibilities relating to the system of what? Internal control. So that is what goes into the control environment. Control environment. Now, the next one we want to look at is the risk assessment. Risk assessment is mostly associated with we understanding how the financial statement is being prepared, as well as also trying to tell about what management identify and assesses and addresses as risk. At least it's able to tell how significant a risk is and the likelihood of it what occurring. That is a risk assessment process. So here we try to identify risks and assess the likelihood of it occurring, and as well to management deciding on what to do about this particular risk. This is what we call the risk assessment process. That is trying to identify the risk, then try to assess the likelihood of it happening, and also the management also committing funds or being committed to decide on what they want to do about the risk that they are for being confronted. That is what we mean by what we call risk assessment process. Another one we are seeing over here is what? The information system. With the information system. Now, with information system, it is concerned about communication. So most often, in some books or in some document, they write information system and communication. and communication. Now, this processes is just looking at how transactions are being initiated. So information system and communication, how transactions are being initiated, how they are being recorded, how they are being processed, how they are being corrected if necessary, and even how they are being shown in the ledger account. That is the information system and then communication. Because they are all part of what the internal controls, how transaction is being initiated, how it is being identified and then recorded, how it is being processed, how is it being corrected if there is what a mistake. That is what we call information system and communication. Information system and then communication. So if an event should happen, if something should happen, how do you record that event in the books? That's the internal control relating to what information system and then communication. If you want to if you want to talk to shareholders about certain transaction, how was that transaction recorded in their book? That is what the information system and the communication. That is the internal control that most organizations put in place. So if you walk into some organizations, they have stated that, okay, if you buy a product from there, show it by the counter, they will use the barcode reader to read it will charge, it will print receipts for you. That is the way they have done it, a way of recording transactions. Sometimes they intentionally do inventory count to know the number of inventory that they have. So that is what they normally do. So if these things are in place and then they are be able to tell you that if you want to do this transaction, these are what you are going to do. That is what we call the information system and then the communication and the internal controls. Now, there is also what we call control activity. Now, with control activities, it's just referring to the policies and the procedures that ensure that management directives are carried out. So I will say here by saying that they refers to policies, so it refers to the policies and procedures that ensure or that help, maybe we can say that help, okay, that ensure that management directives are carried out effectively. This is what we call um this is what we call effectively. This is what we call the control environment. Now, with monitoring processes is just trying to tell you that what are some of the internal controls that they have put in place to monitor the effectiveness of the controls itself. So if the entity want to monitor the effective of the internal controls they have put in place, they do what we call the monitoring processes. So in trying to do the monitoring processes, they will try and identify the internal controls that they have put in place that are inefficient, that are not able to address the issues that they are able to address. So that's what we call monitoring process. So in a monitoring process, what actually happens is that the entity try and monitor the effectiveness of the controls that they have identified and the remedy controls that they also have deficiencies in them. So they try their possible best to do that. So that is what we call the monitoring spirit. Now, even if I am going further, I can even say that with the control activities, that is ensuring that policies and then procedures are what carried out effectively. So even in doing that, sometimes they try to segregate duties. So there's segregation of duties. So here there is segregation of duties. So what it actually meaning that they try to assign each and everyone's duty to him or her to carry out. Then as well to in that same control activities, there is what we call authorization and then approval. Authorization, then what? Approval. Because what are the procedures they have put in place to ensure that transactions or people who engage themselves in the activities, they everybody, each and everyone knows his or her duties. Then as well too, they try their possible best to ensure that at least all the transactions over there was 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 having an authorization or was actually approved by management. In the control activities too, sometimes they can also have what we call verification. Verification. So verification is that they try to verify some of the items, they try to do some comparison and see whether the policies that it needs to follow, they try to do that. Another. Sometimes too, they do what we call accounting conciliation or reconciliation. That is a bank conciliation that people do to see what are some of the controls they have put in place regarding the reconciliation of transactions is ordered. So all these are there to ensure that the organization, the people in the organization carry out their duties effectively. Carry out their duties effectively. Any question over here before I continue? Okay, so what are some of, so after knowing the components of this internal control and me explaining further, I want to talk about the limitations of internal controls. Limitations of internal controls. Now, cost or the internal controls have some cost and benefit. There are times that the cost versus the benefit, the cost may be higher than the benefit they are deriving from what? The internal controls. Because internal controls will ensure that activities are well carried out in the organization. So that's what it will do. But sometimes in trying to establish these internal controls, the cost involved will be so huge, such a way that they will not be able to carry out the internal control effectively. In that case, it can be a limitation of these internal controls. It can be a limitation in the terms of control. Now, another limitation is human error. Human error. Now, sometimes you realize that human beings are the people who some in organization record transactions. So they are typing 15 and they end up typing 51. This is a human error. Sometimes they are typing 30. They wrote 03. It's an human error. So when there are human errors. Because internal controls, they are there to ensure that everything in the organization are okay. But where there are human errors, one or the other two, we can say that is the limitation of this internal control. Another one also is when there is collusion. So when there is collusion, when collusion normally occur where two or more employees cooperate to get around the internal control system. So when we say when there's collusion, this where two or more employees of the organization try their possible best to what? Cooperate to get around with the internal controls. In that instance, you can say that is the internal limitation of this internal controls. And most often, this collusion normally happen when people want to commit fraud in the organization. So if they want to commit fraud in organization, they engage themselves in what? Collusion. Collusion. Another one is management override, or some people will call it management bypass. Management override, or they will say management bypass. Now, when we say management override format, so sometimes the internal controls in such a way that you shouldn't, you should always, that's where the authorization comes in. If you want to make any payment, this person must sign, this person must sign, this person must agree to it. There should be a signature from two people. So all these things are the rules they normally put in place to ensure that the internal controls in organization are truly implemented. But then sometimes people will want to bypass or they will forget that they need to pass through the right system before communicating an information out. In that instance, it can bring what we call management override. Management override. That is, instead of you to go through the formal process, you are just passing through the corners to get things done. In that case, we call it management override or management bypass. This thing can also happen in or as part of the limitation of what? Internal control. The next one is, or the last one is what we call non-routine routine transactions. Non-routine transactions are one or the other two. So in some organization, there are some transactions that normally occur. So if we don't have good internal controls, sometimes it's very difficult to look at how those transactions need to be recorded in the books. For instance, if you happen to find an organization where every day you are selling products out to people, now someone just came in and then said that, okay, I don't have money with me. I don't have money with me, but then give me the product and then let me keep it. And let me go and keep it and later pay. Because you don't have a policy of recording the um transactions that are not routine, or transactions that are not routine. Sometimes you'll find it very difficult to ensure that these internal controls that they have are correct, because the one that it is not routine, it means that they don't have a strong internal control system to check all those ones. So most often, if transactions are non-routine, they can be a limitation of this internal control. When the cost exceeds the benefit, it can become a limitation. When there's human error, it can become a limitation. And then also too, if there's management override, it can also bring about what? Limitation. So how do we know that these controls, they are good, these controls, they are not good? So in order to know them, we test the controls. Test of controls. So before management can, or before an auditor can finalize that these internal controls are not good, or these internal controls are good, unless we test the controls. And the controls, we can have direct controls, and we can have indirect controls. So we have the direct controls and indirect controls. Now, when we talk about direct controls, it normally refers to the sufficient controls that is available, that is meant to prevent, detect, and correct misstatement. So it refers to what we call sufficient controls to detect, prevent, and correct material misstatement. So there are the controls that are there these are there, they are there to detect, prevent, or sometimes to correct or material misstatement. To correct misstatement in the financial statement is what we call the direct controls. And when we talk about the indirect control, we can also call them controls that support the direct control, support direct control. So they are the controls that support what? Direct controls. And this one could be that maybe they may have a system where the transactions are being recorded. So initially, they were using paper and notebooks for their recording. But then, when you visited the firm, now they have an indirect control, as in maybe a point of sales device that is used in recording transaction. So maybe there's a barcode. When you buy your product, then they show it on the barcode. Like when you go to Melcom, they show it on the barcode, and it reads the barcode reader, reads the barcode, then it will record there that this one has been bought. Then it will determine the amount you need to pay. They will show you the receipt, you pay, and then you go your way. Or this one is what? Indirect internal control. They are there. So these machines are there to support what? The internal controls. Now, if they are going to do that, there should be, how do they test if the internal controls are good? So let's look at the audit procedures in testing if the internal controls are good. They can do inspection, they will inspect. They can observe, we can have observation. And the last one, they can do re-performance. So if they want to test whether the internal controls are good or they are not good, they do what we call inspection. And with the inspection, they try to look at the evidence of the internal control procedures that they have. So what they have is that when maybe a supplier is being paid, how is this thing, documents recorded, the type of stamp that they put on it, Who do the filing? Do we place the actual receipt at the actual receipt that bears the supplier's name in a particular document that we can easily find? They try to do inspection, trying to see whether indeed everything is right. So that is a way to test the internal controls. Another one is also by observation. So if they walk into your school and they want to know whether internal controls are okay, they'll begin to watch the people who are performing a job. So as they are performing their job, what are the procedures they have to do? What are the steps are they skipping? So as they begin to observe, then they begin to like, oh, okay, this side is not good. This side, there's likelihood that there could be a misstatement, or there's likelihood that the transactions over here will not be well recorded, looking at the similar thing nature that is happening. That is what happened over there. So the audit procedure, and the audit procedure, we have observation. We also have re-performance. Re-performance is trying to do what the employees have already done to ensure that everything is correctly stated. So sometimes if they want to test the internal controls, they do what we call re-performance. And re-performance is just trying to do what our employees have already done to see whether everything is okay. That is what we call re-performance. So the audit procedure is that they do the inspection, they observe, and sometimes too, they do what we call re-performance. Now, if there are internal control issues, how do we report them? So I've taught you what internal controls are. I've given you the components of internal controls. I've told you that we have the control environment, we have the risk assessment processes, we have the information system, and then communication. We have the control activities. We have the control activities, and the last one, we have the monitoring processes. And I've given you the limitation of these internal controls. And I've told you that to test for the controls, we have the direct controls and the indirect controls. And I made mention that with the direct controls, we are just looking at uh, uh, how the controls that have been sufficiently provided to ensure that there's no misstatement. So misstatement is prevented, or it is corrected, or we can easily detect it. Then as well to the indirect controls, we said they support the direct controls. So if the company have maybe accounts stored on a computer and they have a particular software, that software that they have, one or the other, the auditors try to examine it and see whether everything is okay. If everything is fine, we will say that software that is there is serving as what an indirect control. Then we also mention what we call the audit procedure. So if there are issues, how do you identify issues with a company's internal control? What we do is that we do inspection. We go and inspect whether the internal controls are correct. We go and observe and see whether the internal controls are correct, or we do re-performance. Re-performance. That is a way to see whether there are internal control issues. Now, if you try to identify the internal controls and you realize that there are deficiencies, then you need to report on the internal controls. Even if there are no deficiencies, you can still report on these internal controls. So reporting on the internal controls is just trying to tell us the story whether the internal controls are deficient or they are not deficient. That is what you need to know. So when control deficiency are related to financial reporting, that is mostly identified in the system of internal control, this thing should be communicated to those charged with governance. So those charged with governance, they are the people that if there are issues concerning internal controls, we report to them. So if there's any challenges, if there are any deficiency that you identify, we try our possible best to report to those charged with governance. And most often, when they are doing that, they do that in their management letters. So most often, if they are reporting to those charged with governance, if they are reporting to them, they use what we call written management letters or management letters, which is mostly written formally to these firms that one or the other that have issues concerning their internal control. Now, under what circumstance would you know that, okay, there is what we call deficiency in the internal control? So at what point in time will you know that there is deficiency in internal control? Because we said if there are deficiency, you report to who? To those charged with governance. So now the question would be, when would we say that there's deficiency in the internal control? When you have an internal control and it is well designed, it is implemented, and it is well operated in such a way that it is not able to prevent and detect misstatement on timely basis, then we say the internal control is sick or the internal control is deficient. So if you have an internal control and you are not able to assess or you have internal control that you are not able to prevent maybe fraudulent activity, or you are not able to prevent material misstatement, then we can say that this internal control is deficient. Now, if you find a significant deficiency, if you find a significant deficiency, what do we do? Because we are saying that we want to report. When you have that, when you're able to see a significant deficiency, you first have to report to those charged with governance. And you will tell them to take what we call corrective action. Because if they don't take the corrective action, it's likely to result in material misstatement. Or sometimes we can even lose some of our assets. And sometimes too, it can raise doubt about management. So what happened here is that if there is deficiency, we need to ask ourselves, is this deficient sufficient or it is not sufficient? And that one will depend on the tone the auditor set at the start. That is what must be happen. So the auditor must go to ensure that these divisions that they have, they are able to deal with. If they are not able to deal with it, then they tell management to do the right thing by taking corrective actions. Any question? Does it mean we are all fine? Okay. Now,
Yes, Doc.
okay, thank you. So now, if they want to do the audit, as I said, they need to look through some assertions and know whether the assertions or the class of transactions are truly representing what they are expected to represent. So when they are doing the final audit, they try their possible best to look at the assertions, because we said the assertions refers to the amount of the items that have been stated in the financial statement. So they try and look at it, whether there are issues. Now, then they'll look at it. So here, let me pay attention to some few assertions and then look at some of the things that are likely to happen. Now, we have what we call trade receivables. So in the financial statement, there is what we call trade receivables. And these trade receivables always come with what? A figure. So if I want to ask you this question, if you are an auditor and you've worked in there and you want to go and audit a particular company, and you've seen an assertion called trade receivables, what are the things that you require to do so that you used to confirm whether the assertions that they have made, there is no misstatement in the assertion? So I'm throwing the question back to you, that if you are going to audit a particular company and the assertion is trade receivables, what are some of the things that you use or you do to confirm whether the figures they've written there is correct or there's having material misstatement? This is a question.
So,
And all receivables are dated. So this is a question to the whole class.
yeah. So
Yes.
you look into the debtors book,
Mhm.
that how many people are on you.
Okay. So she said that if she's going to audit the company, she'll look into the debtors book and get to know the number of orders. Yes, indeed, you look through. Yes. But what are the things that you do to confirm whether the figures are correct or they are not correct? That's what I want to know. Because after they presenting the information, yes, you want to verify. So you went for the big book, and then you saw that, okay, this person's name is there, and you added it, and then you saw that it is there. Then apart from that, what are the other things you can do to assess whether the figures are right or they are wrong?
So also look at the daily sales.
Mhm. Daily sales.
Yes.
So because
How
the trade
much
receiver. Mhm.
how much is the company producing, maybe a day or a week? Then maybe how much were they sold? So you compare that one before you get to know the number of items that were sold as uh, that was sold on credit.
Okay, good. Yes, another person, Andrew.
So, Doc, I will also adding to that, I will look for the receipt books.
Mhm.
So when somebody pays, you issue receipt to the person. So maybe the books
Okay,
will confirm what is coming in.
okay, okay. That is good, Andrew. Yes. Who else again? Yes, there are more. Ba.
Kwame, Gifty, Joanne, Letitia, Mercy. Please share your idea. If you know receivables are debtors, so trade receivables. If you're an auditor, you're going to audit the account. And what are the things that you will do to ensure that at least the opinion you want to form about the company, their receivables are okay or they are not okay? What are the things that you do? Yes. Who is talking? Fami, are you talking?
Say,
Yes, please.
I'm of the view that you are going to check your cash receipts and then
Mm-hmm.
to confirm whether customers have paid their debts or there's some outstanding.
Okay. Okay, fine. Yes, who else again?
Yeah, please. If
Yes.
let's say after receiving all your debts, you deposit money into your bank accounts, you just go for bank statement and reconcile it to your cash book to see if everything is intact.
Okay. All right. Okay. So that is all good. So what I can also say here is that one, we can look at all the individual balance. That's why our sister said we have to go into the books of account. So we go into the individual balances. So if we have like 10 receivables, we go through all the individual balances and ensure that their figures, when we add them together, they are equal to the final figure that we are seeing in on the face of the account or the statement of financial position. That is what they do. If they don't agree, we try our possible best to do the reconciliation. Now, if also another one also you can also do is that if they are older debts, if there are some people that they are owing us for some time now, we think based on the discussion with management, they are thinking that or together with us, we are seeing the risk of they defaulting the amount of money or they not be able to pay the amount of goods that they bought for us or the amount that they owe us. Then it's like you're trying to confirm the actual bad debt that they have indicated in the books. Because sometimes businesses can indicate bad debt here. And we want to find out, okay, this bad debt, is it with respect to the older debt that they have, or is the current debt that they have now, but then the terms of collection or how debtors are going to pay their payments, the ones that they have is not more attractive, such a way that debtors will be able to pay their debt on time. So we'll try and then look at that one too. Then as well too, when we are looking at the trade receivables, we can also look at the collection period. How many days does it take for debtors to pay their money to us? So we look at the collection period. Some of days it takes them. So by trying to do the calculation to determine the number of days that they're able to. So if you realize that the number of days that they have over there is lower, that it takes lesser days for debtors to come and pay us, then it is possible that the control environment they have in place is what it is better. Sometimes too, they can also do some tracing. They try their possible best also to trace customers' accounts, and they will look for the copy of the invoice that was issued to them. If there was a dispatch note, they will look for it. If there was an order from the customer, they will look for it. So if I'm saying that maybe Gifty is owing me and I'm the business, and then Andrew came to audit me, or Andrew would then begin to ask, okay, when Gifty was requesting goods from me, did she give out a request note? And when I was selling the goods to her, did I invoice the goods, or I just said, take it and go because maybe I know you and you are my student? That's the reason. So you take it and go. Or Andrew begin to also say, okay, when I was sending the goods to Gifty, did I add maybe a rail bill or a dispatch note? And when Gifty also received the goods, did they issue out goods received notes? So all these things, the auditor tried to trace them. If he's able to trace all these transactions, then we are saying that he's trying to confirm the assertion of what? The trade receivables. Another thing also he can do is that he can go into the cash book and look for up to date how much we have received from the debtors in a way to confirm whether indeed the amount that they are owing us. So maybe the total amount they are owing us, or the total amount of sales is shown, then as well to the one we receive cash, we deduct it from the sales, then you actually get to know the credit sales. Then you compare to the one represented in the financial model, that figure is what is showing there. It's a way of tracing the transaction to ensure that the figures we are seeing or the assertion they have made in the financial statement, it is true or it is not true. So that is what they do. Okay. Sometimes too, after they're doing this tracing, they can do substantive procedures. Substantive procedures, they do analytical procedures. So these analytical procedures is where they try and compute the collection period of this year. So this year is what they are. The figures that they are using is the. So this year's figures, they will audit them. Then as well too, they will compute this year's collection period. Then they will compare it to last year collection period and look at it, whether last year it took more days for debtors to pay, or this year it is taking them more debtors. Now the number of days is long such a way that they're not able to pay us on time. So they do what we call analytical procedure. That's what they do then. So when they're also doing the substantive procedures, when they're trying to do the tracing and the testing, they are trying to trace the transaction. Sometimes if the transaction has passed through the bank, if they want to trace the transaction, they are doing substantive procedures. Substantive procedures. Okay. Now, let's look at another assertion. That is trade payables. So another assertion we can see in the financial statement. So who can tell me, how do you confirm the figures? Based on what the lengthy thing I said about this receivables. If you were the one who is going to audit the company, what are the procedures you will use in confirming the figure for the trade payables? What would you do? Please, you have to demonstrate, you have to talk. What are the things that you do?
Yeah, please.
Yes,
I will check
please.
the payable. I will check the payable periods as compared to the receivable periods to see if everything is intact.
You say you compare the payables period with the receivables periods.
No, I will check the payable period to see
Mhm.
the time in the system.
So you check the payables period to know the number of days it takes us to pay them. Is that the case? Okay, so
Understand?
as we will, yes, sir.
Um, I'll verify the total individual suppliers account,
Hmm.
and then to check if they are equal to the trade payables control account. And
That's
as you
fine.
rightly said, if there are any sort of discrepancies, I do verification, or then I make that I investigate the differences, and I
Right. That is good. That is good. Okay. Who else again, or any other point you want to add? We are looking at the
So,
accessions. So yes. Mhm.
so Doc, as you also indicated, at
Mhm.
after that, you can also do the analytical procedures where you compare the current year payables with previous ones. And then again, you can also check the or compute the payable days to see. And then if there are any, you can go ahead to also investigate unusual increases or decreases in balances or trend as an auditor.
Okay, good. Good. Another thing from any other person, any other point from any other person.
so let me add this.
Please add.
Um, you have to also check if there is a proper purchases authorization, or authorization of purchases that have been made.
Okay.
And you have to also look at the invoices that have been prepared, whether they match with the goods that have been received.
Good, 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 good. That is good. Right. Any other thing else again?
So, sir, to add
Because
to the Erasmus, so
Mhm.
just as he indicated, the supplier invoices, you can also look for the goods received note, the purchase order. All these things will help you to confirm that those materials are duly received or it passed somewhere else.
Right. Good. Now, note that there is no audit question without we testing the controls of an organization. Every audit question has test of controls. So, some point in time, it may be receivables issues. So you need to read the question and say, tell us the things we need to do. There are times it may be payables issues. There are times it may be inventory issues. Inventory issues. At times can be cash and bank transactions. At times there can be accruals and prepaid. 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 So there are times that there can be accruals and prepaid, or some people call prepayments. Sometimes they can be issue concerning the payroll. We need to look at them too as well. So it's not just about we just looking at them like that. It's about we discussing what are the things you can do. So now that our brothers were able to tell, let us look at the inventory, assuming that you have inventory. What are the things that you can do to ensure that the inventory figures that they are giving to you, they are right? What are the things or what are the procedures you are going to follow? Yes.
Okay, Doc, let me start and
Yes,
then
please.
my colleagues will also follow.
Okay.
So, in terms of inventory, just as you indicated, first of all, the auditor has to understand and then evaluate the internal controls. Now, in so doing, the auditor has to look at the inventory. If there is an inventory management system, that is how goods are purchased, how goods are stored, and then how it is issued to department and then recorded. All these things will help the auditor to in his work. When he also has to check whether there is a regular stock count or otherwise. And I believe that these things will help the auditor in his work.
Okay.
That's the first one. I'll come again. My brother
Right.
Foucault.
Right. So I'm waiting for them. Our brother Andrews has set the pace. Yes. Erasmus.
Say,
Okay.
say,
Yes, please.
as my brother Andres was talking about the stock count,
Mhm.
when it is done, I am of the view that the auditor must also compare the result of the count with the inventory record that the company or whosoever matters has with the general ledger, because all these things are going to be recorded in the general ledger. So there should be a comparison of those counts with the inventory record that they have. And if there is any sort of differences, the auditor can also look at it and address it.
Right. That is fair. That is good. That is very, very good. Yes, please. Who else again want to come in?
Yes, the auditor also needs to look at the inventory cut off.
What
He
do
or
you mean
she,
by the inventory cutoff?
that is to verify that the transactions are recorded in the correct period.
Okay.
That's at the time that uh, the inventory took place or the transaction took place. Then again, they should review the documentation, whatever that they have recorded, the stock, the receipts, the payments, and everything. They have to get the documents and then check properly that everything is in order. Thank you.
Okay. Good. So maybe our revision period, we will look at cases where we will face the real life issues or the issues will be hidden in the cases. So we will pay attention to them and then come out with some of the controls, the procedures that we can use to test the controls in the organization. What about bank and cash transactions? What are some of the controls or what are some of the ways that the procedures we can follow to ensure that the figure we are seeing there it is correct, or if there are issues, we are going to rectify them or we communicate to those charged with government. What are some of the things?
So
Okay,
bank
sir.
reconciliation.
Yes, please.
Okay.
You read the auditor should regularly reconcile the bank statement with the company's record to ensure accuracy, and then differences, when there is differences, he or she will be able to identify.
Okay, that's good. Yes.
Sir, sir, can you hear me?
Please, I can hear you loud and clear.
Yes. Because records are made in a cash book, and the auditor have to check all receipts and payments that have been made, whether they have been recorded properly, and there are no errors in the book, and then to see if those balances agree with the general ledger totals.
Okay, okay, okay. So do we advocate that the auditor should be able to verify all unpresented checks? We're going to verify all outstanding deposit that is yet to be credited into the account, do a reconciliation, as well as ensure that the balances of the balances in the bank state, sorry, in the financial statement agrees with that of the bank statement. And as well to, do we also think that the auditor should ensure that the client who says he has enough money there has ways of keeping the transactions very well in such a way that they have enough ways, or they're able to determine how possible best, maybe if they are having an interest system, this interest system is being regulated and how it is being controlled. Do you think that the auditor must be interested in all what I have said, or the auditor should just pay attention to just the transactions recorded and that is all?
Though,
Yes, please.
say yes, all what you have said is very true. The auditor must be interested in all those things, because I remember in one of our engagements, you told us that the banks that collapsed, the auditors, in one way or the other, were assuring that they were in good standing, but it wasn't so. So I think that for an organization to be strong financially, as we are saying, all those that you have mentioned needs to be in place for them to be strong financially.
Right. Thank you. Thank you. So you have the duty to um you have the duty to try as much as possible to know the controls that they normally put in place, or they have to be put in place for this accession, and as well to know the test of controls that the auditor needs to, for the procedure the auditor must follow to test the controls so that everything is right. You need to know them here. So at any point in time, when you are called on them or it is in the question, you'll be able to discuss the issues very well. Now, when we are carrying out the audit, we need to document our procedures. We need to document everything that we are doing. So in auditing, we have what we call documentation and quality management. Audit documentation and we also have the quality management. Now, when we are talking about the documentation, we are saying that all the works of the auditor should be properly be done. Or when they are doing it, all the work should be done very well so that we will be able to collect sufficient evidence. So if the auditor is able to collect this sufficient evidence, it will actually support the opinion he will make. So if the auditor is going to undertake the audit, he needs to ask himself, what are the documents I will need? Which type of people that I will need that will aid me in the documentation of my processes? Because based on the documentation of the processes is what will inform him that, okay, I was able to do this. There was no evidence. I asked for this. They didn't give to me. I asked for an audience for management to make a presentation. They didn't come in. They didn't do anything. So all these processes, he is able to document very well. So based on it, they can say that because I didn't receive sufficient evidence, what it means, I give a disclaimer opinion. Then he will give his opinion. So anytime there is audit documentation, even it helps them keep records of what the procedures that they use, so that in future, if they want to come and audit the same company, they'll tell them, so okay, when we are auditing, we went through this, we went through that, we are from this side, we did this. That is the audit. So it can help them in their future audit. Now, when they document their processes too, it also ensures that other auditors, so maybe they may be they have a team, audit team, but then there will be seniors and there will be juniors. So if the juniors are documenting the processes, the seniors can review the processes that they have been able to document and check whether they are doing the right thing in the auditing process or they are not doing the right thing. So documentation is very, very key in this process. Now, in the documentation, they have audit files. They have audit files. And these audit files is normally contain information that one or the other, it guides them in their processes. So with this audit file, it's able to tell them that, okay, when we collected this sufficient information, we place it here. This information, we kept it here. This information was in this angle. That's the audit files. We have two types of audit files. We have the permanent audit files, and I'll explain all of them. Permanent audit files, permanent audit files, and we also have, or we can call it audit file, and then current audit file. Current audit file. Now, when we talk about the permanent audit file, it contains an information that we cannot change. We cannot make changes to them. So if they are going to audit the company and they are doing their documentation, the name of the company, they can't change it. The type of business, they cannot change it. The name of the company's bankers, they can't change it. The name of the lawyers, they can't change it. The organizational structure of the organization, they can't change it. So all this information that they get, they put it in their permanent file. But then with the current file, we can see the financial statement they are going to audit over there in the current file. We can also see other evidence that they have obtained that they want to look at them and see whether it can inform their opinion. You see all of them in the current file. So with the current file, we can easily make changes to it. But with the permanent file, we cannot make changes to them. So with the current file, you see financial statements there, statement of profit or loss, statement of financial position. You see there, then there maybe some assertions that was being verified. So maybe they verify the statement of profit, they verify the trade receivables, they verify maybe the bank and cash transactions. They're able to verify maybe the sales, they verify the taxes. All these things they will be, if they're able to verify, they keep all this information in the current file. But with the permanent file, audit file, they contain information that they cannot make changes to it. They cannot make changes to it. That is what. So if this in the current file, we see the financial statement, we see the document they are working with. So in the current file, they will also see what we call working papers. Working papers. And this working papers is actually telling us about the type of items that we are dealing with, the type of items that we are holding on to in our preparation of or in our auditing processes. So now, what are some or in these working papers? We can see some of them. We can see the title of that working paper. You can see the date that they will prepare that working paper. You can see who prepared that working paper. You can see which of the issues that they are referring to. So maybe if they are referring to issues concerning receivables, so and it is that paper, the computation that they've done, maybe the analytical procedures that they've done, all of them can be seen in their working papers, because those working papers will guide them in forming the opinion about the entity. And if maybe they have been able to conclude on the work performed or on that particular issue on that working paper, they're able to tell that. And then also, if there are any suggestion, that was me, you can see all of them in the working papers. So these working papers, we can see them in the current audit files. Now, in documentation, we also have what we call quality management. And there's a standard for that quality management. It's ISA 2220. That is quality management for audit of financial statement. So we have quality management, which the auditor should be guided with this ISA 220. And the name of it is called Quality Management for Audit of Financial Statement. So this standard itself is just trying to look at the quality management of the engagement activity that will take place during the audit of the financial statement. So this quality management or this standard is just trying to look at the level of quality that must be there when they are, or the quality management of this engagement level when they are going to audit the financial statement. So most often there is in the with the quality management, you have someone who is called an engagement partner. Remember that I told you that if before we audit the company, when they write to us that they have appointed us as auditors, we also write to them and give them engagement letter. The one who will ensure that all the things we stated in the engagement letter is adhered to is what we call the engagement partner. So we will have the engagement partner who is ensuring that there is quality management with the audit of the financial statement. So the engagement partner, whose duty also will be stated in the engagement letter, is responsible for quality management. And you will ensure that the audit is conducted in compliance with the international standard of audit, in compliance with IFRS, in compliance with IAS, in compliance with the laws and the regulations that govern the client in the particular jurisdiction that they find themselves. That is the engagement partner. That's what you do. So the engagement partner who is in charge of ensuring that there is quality, he will ensure that the quality of audit report is being given out. He will ensure that the audit process is being conducted in accordance or in compliance with the relevant laws and regulations governing the auditing process. That is what you do. So the engagement partner does that. That is what he will do. So in his engagement, he will direct, he will review, he will supervise all the actions that needs to be taking place so that the audit process becomes successful. That's the engagement partner. So the engagement partner comes in over here. Now, with this quality management of which the engagement partner is ensuring that they are components of it. They are components of this engagement, so audit, quality management component. And the component, some we pay attention to the leadership. That's the first component. And when we talk about the leadership, it is actually referring to how the firm is able to communicate the expected behavior of the engagement team members. So with the component of ensure, because the engagement partner is the one who is ensuring that there's quality in the activity that they are going to do. So in terms of the component, as part of his duties, he wants to ensure that there are leadership being portrayed in the processes, such as actions that will reflect the firm's commitment to quality, because the firm must also say that we are interested in quality. We are interested in the behavior of your engagement team members. So that is where the leadership issues come in. Then as well, to another component of this quality management is that we pay that there is what relevant ethical requirement. Relevant ethical requirement. So this relevant ethical requirement is that with the engagement partner in ensuring that there is quality management, he also will ensure that the report that they are going to issue to the client is provided on time, and that the auditors will act ethically. So with respect to, I've talked about the ethical threats, self-review, self-interest, advocacy, what else again? Intimidation, and the fifth one is what? Self-review, self-interest, advocacy, intimidation, And the last one is what? Yes. Yes. Or you don't remember? Yes. Hey, so right now you've forgotten. Or you can't hear me. I said the threats, self-review, self-interest, advocacy, intimidation, and what? What the last threat is what? No one is talking. Familiarity is a threat. Familiarity is a threat. Okay. So the engagement partner will ensure that there's relevant ethical requirements of which the people had not complied with it. Again, another component is that of the quality management that you will ensure that there is what engagement resources. And I'll explain the engagement resources. With these engagement resources, we are looking at the resources that will be sufficient and that will be appropriate and that will be provided on time for the audit processes. That will be provided on time for the audit processes. That is what it is. Then we can also talk about the other component is that we also have ensuring the quality management. We also have engagement performance. It's also another component. And this engagement performance is looking at who is responsible for supervision, who is responsible for review, who is responsible for consultation in case there is difficulty, who is responsible for ensuring that there's engagement quality. That's what we call the engagement performance. That is what happened. Then in the supervision, so in the supervision or direction, we are just looking the supervision matters maybe including who is monitoring the progress of the audit. It's also part of the quality management. Who is addressing the issues, that is assigning or reassigning audit procedures to other people to do it. Because if there are issues, because supervisors, if there are issues, they need to address them. So in the supervision, he tried to assign some of the audit procedures to new people because he thinks that those people, maybe they may be overwhelmed with the audit process. So let us give it to another team to work on it, but they may be part of what the main engagement team that we are dealing with. Then, in terms of the direction, so who is performing the audit procedure? Who is also fulfilling the relevant requirement of what the ethical principles that you need to follow? And we all know that as part of the audit, we need to ensure that there is integrity, there is confidentiality, there is professional behavior, there is professional competence, there is confidentiality, professional behavior, there is integrity, there is professional competence, and due care, and there's objectivity. These 5. Who is ensuring that they are all part of what? The quality management. So anytime there is quality management, the engagement partner ensures that all these are fulfilled in the process. So your reading assignment I would like to give to you is that go and read on what we call engagement quality review. Engagement quality review. So kindly read on engagement quality review. And then on Sunday, you discuss it with me. Engagement quality review. And as well to maybe read on the deficiencies in quality management. And also you can also read on efficiency in quality management. Don't go and do chat sheets where it is not relating to the audit, or it is something should be related to audit. So if you are searching for your information, search it well so that you get the right information for me. Any question, then we can end the class and meet on Sunday, 6 p.m. Any question? As we agree, so we are doing it 2 hours, so that at least we can have understanding about the course. So next week, or by Sunday, if you are able to do that, we will look at issues concerning maybe fraud. We look issues concerning fraud. Right after issues about concerning fraud, we will look at audit opinions, audit opinions and audit reports. So God willing, Sunday, that's what we do. After fraud, we will look at audit opinion and then audit reports. Any question? Okay. Since there is no question, then I would like to leave and for us to meet God willing Sunday. Have a good evening and thank you.
Thank you, sir.
Thank you.
Thank you.
We are grateful.
Thank you.